Hi everyone, welcome to another ShareWise webinar. Today I am fortunate enough to be joined by the joint CEOs and executive directors of Cobram Estate Olives, Sam Beaton and Leandro Ravetti. Thank you so much, Leandro and Sam, for joining me today.
Thank you.
Thank you.
So today, Sam and Leandro will take us through a presentation, and then afterwards we'll do the Q&A with everyone. So feel free to pop in your questions in the chat Q&A below, and then we can go through them after. I'll hand it off to you now.
Thank you very much, Caitlin, and thanks for those joining us. Today, we'd like to take you through our results for the 12 months to 30 June 2023. In terms of agenda, I'll talk through the financial and commercial highlights, and then I'll hand over to Leandro, who'll take you through our operational highlights, and of course we'll have time for Q&A at the end. In terms of our results for the 12 months to 30 June 2023, we announced our results on Friday, as some of you may be aware. We had a very strong year in which we saw sales grow 21% to $169 million. Pleasingly for us, we saw sales growth across both Australia and our USA divisions. And we also reported growth in Cobram Estate in both Australia and in the USA, and Red Island, growth in Red Island that we sell in Australia. From an EBITDA perspective, 63% growth up to $40.8 million. This was expected as we had an on-cropping year in Australia, and under accounting standards, you're required to measure most of the profit relating to the crop in the year of harvest, not in the year of sale. So we did expect an increase in profitability. From a 2-year rolling average EBITDA, which takes into account both a lower cropping year and a higher cropping year like this year, our EBITDA was $30.1 million versus $47.9 million in the prior year. And that's because our higher cropping year this year was lower than our last higher cropping year in 2021, where we had 16 million litres, and this year 12.5. Leandro will talk through why our crop wasn't as high as we expected when he gets to his section. Pleasingly, from an operating cash flow perspective, we reported a record operating cash flow of $54.1 million before interest and tax, which is up 60% on the prior period. And at 30 June 2023, we had undrawn facilities and cash of $56.4 million. In terms of our performance by division, pleasingly, we reported improved profitability across all our business segments, both Australia, USA, and our innovation and value add. In Australia, our EBITDA was $38.5 million, up from $32.4 million. This was driven by the increase in the Australian crop. It was offset slightly by the product mix we sold, particularly in the first half of the financial year compared to expectations. More of our oil went through private label and Red Island. In the second half, we put through a price increase of our Red Island product range and our Cobram tin. So certainly that margin impact was corrected in the last several months of the financial year. We do sell some of our low-value bulk through the USA as well. So the margin on that product is shared between both the Australia and the USA division. The USA division, a very pleasing result there, where we turned a $4.7 million EBITDA loss into a $2.9 million EBITDA profit. This was driven by the increase in sales, and we also saw an increase in margin of the product we sold, particularly in the second half of the financial year. We put through a price rise across all our packaged goods in November 2022. Innovation and value add, an improved result there, a small loss of $800,000 compared to a loss of $2.6 million in the prior period. This business continues to focus on B2B and adding value to our waste, and we move into the next year with a continued lean cost structure in that division. The only other point here is our interest did go up. A portion of our debt is variable. We do have $60 million of fixed interest swaps. But we are exposed on the balance of the debt to the variable interest rate, so interest did go up for the period. From a cash flow perspective, a very pleasing result for the year, and I think cash flow really reflects the ability for the business to manage our crop between a high and a low cropping year. So we manage our oil over that 2-year period, and that's purely because our customers buy oil very consistently, month in, month out. So what we see is much more smooth operating cash flow compared to our volatile earnings, which go up and down with the low and high cropping year. A record operating cash flow of $54.1 million, up from 33.8, or $39 million after interest and tax, compared to 27 in the prior period. We continue to invest heavily in capital projects. We invested $56 million cash in capital projects. The majority of that went to major capital projects, which are expected to add material benefit to the business in the medium term. And Leandro will talk you through those, particularly our growth plantings and our milling, increase in milling capacity in both Australia and the USA. And as I touched on at the start, we had debt and undrawn facilities of 56.4 at 30 June 2003, which will enable us to continue to invest in growth projects in the coming period. In terms of balance sheet, net assets of $288 million. A couple of important points here: that our trees and irrigation infrastructure are recorded on our balance sheet at written down cost, not at fair value. There's $121 million of value that sits outside of our balance sheet, so valuation above book value. There's not recorded on our balance sheet relating to the trees and irrigation infrastructure. Our brands sit on our balance sheet at cost, which was $6.3 million within that intangible asset line. So that is not, the brands are not recorded at fair value. In terms of our liabilities, just one thing to point out there, that our tax liability of $80 million, the majority of that relates to a deferred tax liability. And that was created when assets were written up for accounting value, particularly land and buildings. So it would only ever be realised or payable if we sold the assets outside of the group. Gearing did increase to 30%. This was expected as we drew down our debt levels to fund major capital projects combined with operating cash flow. And just to point out, our gearing was at 37% 2 years ago at 30 June 21. From a real property valuation, this chart here and the table shows a walk from our balance sheet assets to our asset valuations. It deducts intangibles and the right of use assets, but then adds in the external valuation, which is not on our balance sheet. As you can see, our assets increased to just under $720 million. This valuation does not include any value attributable to the brands and compares to borrowings of $191 million. And we've got a comment there, but our global brands are now sold $117 million of product during the financial year. Moving on to sales, this is just the Australian packaged goods sales. Very, very pleasingly, we saw a 15% growth in sales during the year. And we saw growth in all three of our channels: Cobram Estate, Red Island, and private label. We did put through a price rise of our Red Island product range in February 2023, and our Cobram tins. The pricing of our Cobram bottles is currently under review. 7% of our sales is Cobram, 25% Red Island, and 10% private label, and 8% bulk. Pleasingly, we sold an additional 1 million litres through our packaged goods channels during the financial year. In terms of where we sit in the category, we have just under 35% market share in the overall olive oil category. Cobram Estate remained the number one brand at 24%, and Red Island number 3 brand at 10.6%. We did see good growth in Cobram, 6.8% growth in value and 6.4% in litres. In terms of marketing, we continue to invest, or invested heavily during the financial year in marketing initiatives. Our marketing is really spent around educating the consumers around the quality of Cobram Estate olive oil, and of course the health benefits and usage. You may have seen us advertised on mainstream media such as TV and outdoor, and we're doing some on radio at the moment. And we're also continuing with innovative campaigns such as our virtual olive oil tastings, which have been a real success. Moving to the US was pleasing for us. We did return to growth, 46% year-on-year growth within that division. And probably most pleasing for us was the growth in Cobram Estate. Cobram Estate grew in sales by 69.3%. And we also saw growth in bulk sales. The majority of that is the low value oil that we sell through the business, of which some of that comes from Australia. Private label was down, and that was due to oil availability and the prioritisation of oil into Cobram Estate. From a supermarket perspective, so this is external data on supermarket sales in the USA. It does exclude some of the bigger retailers like Costco and Whole Foods. But during the year, we saw a 22% growth in supermarket scan sales, so what the customer actually pays compared to the prior year. And we saw a 19% increase in store count, which was very pleasing. We had some big wins towards the end of the financial year with acceptance into Publix and into Kroger, which adds almost an additional 1,800 stores. In terms of marketing, very similar messaging to what we do in Australia with our Cobram Estate Californian range, really marketing around the local, the freshness and the health benefits of extra virgin olive oil. We do focus more on digital, and marketing in store really do increase awareness in the USA. So before I hand to Leandro, the outlook for the business, we've had a strong start to the financial year, albeit it's only early days. The sales outlook certainly remains positive, and we are benefiting from the global shortage of olive oil and record high prices of European oil, and most of our competitors in Australia and the USA predominantly source their oil from Europe. In Australia, despite the lower than expected crop, we do have sufficient oil to meet our packaged goods needs. In the USA, Leandro will speak more about this, but we're expecting a bigger harvest this year, which we expect to continue to drive sales in the USA. And from a cost perspective, we've seen either soft costing going into 24 in the case of items like water, and then other key inputs such as fertiliser, electricity, we're seeing them stabilise, and we expect this to continue into FY24. We did announce that the board intends to pay a dividend of 3.3 cents per share. This will be formally announced at the AGM in early November, and including details around payment date, franking levels, and DRP details. So I'll hand over to Leandro. Leandro will talk through the operational highlights, and then, as I said, we'll come back for Q&A at the end. Thank you.
Thank you, Sam, and thank you very much to all of you joining us today for this presentation. As Sam moved to that slide now, I'll provide you with a brief update on our operations in Australia and the USA, and also how we continue to make progress with the strengthening of the company's 4 growth pillars. I won't go through the figures in this slide in detail because Sam has already spoken about some of them, and the rest will be covered with throughout my presentation. But fundamentally, what they show is the consolidation of our company as one of, if not the largest, fully vertically integrated olive oil company in the world. Move to the next slide. From the operations point of view, this financial year 2023 saw arguably some of the most challenging environmental conditions, not just to our business, but to many other agricultural companies across the eastern seaboard of Australia. with well above average rainfall conditions, particularly during spring and winter, that led to widespread floodings that you probably all heard about. And that is why the overall positive results that I'm going to talk about, today are so encouraging, because they reflect the resilience of our business model and the great group of staff that we have that make it possible. As we previously announced throughout the year, the higher than average spring rainfall and sharply cooler than average spring and autumn temperatures led to a 10-day delay in flowering and actually a shortened growing season overall, that end up producing smaller than average olives, with lower than normal oil accumulation, that ultimately impacted in our olive oil yields. The achieved volume of 12.5 million liters this season was 32% higher than our 2022 crop, but 24% lower than our original projections. The production of those 12.5 million liters, combined with 1 million liters of third-party growers that we processed, was of really great quality, and it guarantees our supply to meet the company's packaged goods sales for this financial year. Although it is far too early to call, but really good growing conditions during summer and the later crop in 2023 have resulted in good levels of growth and productive potential across our groves as we head now into the 2024 Australian harvest. Move to the next slide. Probably a positive aspect of the weather than average year has been the impact on water prices. As you can see from the graph on the right-hand side of the screen, we paid a weighted average price of $38 per megaliter for all our water requirements, and that is about 20% of our long-term historical average price. We anticipate that the water prices are likely to remain below that long-term average for this financial year, as the water storages across the Murray-Darling Basin are at around 94% capacity, quite similar to the levels that they had last year. We also expect, as Sam said, the prices of other key grove inputs, such as fertilizer and electricity, remaining contained over the next 12 months. Move to the next slide. We'll talk a bit about the USA. The weather conditions have certainly been more favorable for our American operations. Significant rain and snowfall during the Northern Hemisphere winter and spring provided a welcome relief for Californian water users in general, including the irrigation district where our groves are located. And that resulted in full water allocations for the growing season. Californian groves are typically harvested between October and November, with the groves having been already through the peak flowering period and already started the oil accumulation phase. The flowering was good, and we are hopeful of a materially larger harvest than in the harvest 2021 or 2022. And this is the consequence of our maturing orchards, more acres under contract, and also the fact that it is largely an on or highly productive year for California. Although, as usual, obviously the final results will always be subject to the weather conditions from now until harvest. Move to the next slide. Finally, to wrap up our presentation, I'll touch on the key developments related to our 4 growth pillars. These pillars are quite simple and focus on producing more oil from our Australian olive groves, through maturing trees and efficiency gains, growing our fully vertically integrated business in the United States, growing branded product sales with a focus on improving the net price or the return per liter of our oil, and also capitalizing on our sustainable position and upcycling of the olive oil byproducts. We'll move to the first pillar and some of the key points there. To give you an idea, with our modern production systems, olive trees reach maturity and maximum production levels when they are approximately 8 years old. And given the significant investment that the company have done over the past decade in new groves, our mature area in Australia is set to increase by 64% over the next 9 years, as 28% of our trees are still immature, so somewhere between 3 and 8 years old, and 11% are not yet productive, so either just planted or less than 2 years old. This is extremely relevant in terms of the future, as many of our production costs per hectare are actually fixed. And this first growth pillar is directly related to the improvement of the company's financial performance, with the value of the additional oil to be produced mostly flowing directly as profit. It is also relevant in terms of the limited world supply of olive oil, was particularly clear this year and most likely next year, and also considering that Australian grown olive oil still accounts for less than 50% of the total domestic consumption here in Australia. Move to the next slide. Two main capital projects took place in this past financial year in relationship with this very important first growth pillar. The first one has been the upgrade of our on-site mill at the Boort Grove. You can see the photos here. This is a great engineering project and was completed on time for the start of the past harvest in late April, increasing our future capacity by over 160%, making this mill one of the largest mills in the world. Sincere thanks to all our staff and contractors involved, as this was done on a very tight time frame, because we needed to have it completed between the end of the 2022 harvest and the beginning of this harvest. We'll move to the next slide. The second large-scale capital project in Australia has been the completion of a greenfield 407-hectare olive grove planted between March and April this year at our Boort Grove in Victoria, just to the southeast of existing groves. As a result, our total olive plantings at Boort increased by 13%. I think it is worth highlighting also that the 270-hectare redevelopment of our Women Grove, which is planned for this financial year, will be the last of any significant capital projects for Australia in the near future that are needed to support the organic growth of production expected from the maturing orchards that I explained before. We'll move to the next slide. As we have heard from Sam, oil supply continues to be our main growth limitation in the USA. Consequently, I just want to highlight some key operational points aiming at improving this situation. As you can see from the graph and the table in this slide, we are expecting a significant boost to our California supply from the maturing profile of our own groves, given that over 80% of the currently planted area of 558 hectares is either immature or is yet to start bearing fruit. And almost equally important in terms of securing future olive oil supply, we have increased our third-party grower area under contract to 2.1 thousand hectares, up from less than 1,300 hectares in FY 2021. That is a growth in contracted area of more than 60% over the past 2 years. We move to the next slide. Regarding this growth pillar, we also have other two key capital projects on the go. Firstly, we have the execution of the phase 1 of what we call the Dunnigan Hills Ranch development, with 205 hectares of olive planted in May and June 2023. There is a further 158 hectares of the phase 2, which is planned for development in this financial year. And secondly, we are currently undertaking the much needed expansion of our mill, oil storage, bottling, and warehousing operations in Woodland, our headquarters in California. The expansion will double our milling capacity and will increase our olive oil storage capacity from 2.9 to 4.5 million litres. And we will be also installing a new bottling line and expanding our finished goods warehouse in line with the projected growth, both in oil availability and sales over the coming years. Next slide on the third growth pillar, which, as I said, is focused on increasing the return per litre on each litre of olive oil sold. There were several concurrent initiatives that included using innovative marketing and education strategies. Sam touched on some of those, like the virtual tastings, but also the ongoing healthcare professionals educational campaign. Also developing and launching higher value items across both grocery and online sales channels, such as our direct-to-consumer recyclable pouches that you can see on the left photo, or our ultra-premium collection listed in major supermarkets to the right of the screen. And finally, in this point, is also important for us optimizing the actual selling price, through the management of the depth and frequency of promotions and also regular pricing reviews. Move to the next slide. This is the second last one. In 2023, we have another very active year in terms of sustainability and value-add growth pillar. We actually very pleased with the results of the strategic change that we adopted regarding this area of the business a couple of years ago. We're moving now into this new financial year with a lean cost structure for this division, mainly focusing on selling our byproducts directly to food manufacturers, hospitals, nurseries, and other businesses, both as ingredients or as renewable energy sources for heat and electricity production. Just to give you an idea, a total of 7.4 million kilograms of olive biomass was sold to external parties this past financial year. The nearly $2 million performance improvement of this division in financial year 23 would have been even higher if it hadn't been for the necessary provision of obsolete stock of $1.1 million linked to the decision that we made a couple of years ago to discontinue retail sales of our wellness products in Australia and the USA. And finally, to wrap up the presentation, I would like to highlight that we have submitted our Australian carbon sequestration project with Verra as a first step to potential certification of our growth-driven carbon credits. Let's remember that based on independent studies we commissioned, carbon sinks on our growth, both in the below and above ground biomass, entirely offsets the emissions associated with growing and marketing the olive oil, leading to a net removal of around 4 kilograms of carbon dioxide per litre of olive oil produced and sold. Pleasantly, all these efforts were independently recognized by the Australian Financial Review and Boston Consulting Group by naming us as a sustainability leader in agriculture and environment for second year in a row. And we were also declared winners of the 2022 Woolworths Better Tomorrow Award, which was formerly known as Sustainability Supplier of the Year, and also winner of the 2023 Coles Sustainability Award. I think that's all what I have for today. So happy to hand it back to Caitlin, to help us coordinate any questions you may have.
Thank you so much, Sam and Leandro, for such a great presentation. For those that joined in late, please put in any questions that you have for Sam and Leandro in the Q&A chat box. Otherwise, I will get us going. So when you think of olive oil in Australia, I think most Australians automatically associate it with Cobram. But besides this strong brand recognition that you guys have, what are other areas of competitive advantage?
Yeah, I think what's probably really important to understand is the scale and the vertical integration of our business. So we produce above 60% of Australia's olive oil from our own plantings. All those trees are actually owned by us and sit on our balance sheet, and we market around 10% of Australia's olive oil from third parties. So the big advantage we have is the scale, and we're able to produce exceptionally high quality extra virgin olive oil, but not only do it at right at the bottom of the cost curve per litre. And not only are we able to do that, but we're then able to sell it through our market leading brands, both Cobram Estate and then our secondary brand, Red Island.
Okay. And I know that you mentioned before that there's some upcoming price increases. Besides the olive oil shortage that is happening, are there any other factors that's driving this global olive oil prices to record highs?
Look, I think fundamentally, there's two things that are worth highlighting here. The spike of the price in olive oil at the world level is mainly driven by climatic conditions being, that have been negative, particularly in the Mediterranean in general and Spain in particular. That has been happening for a couple of years, but also because the new plantings with olives are actually quite limited and certainly barely catching up with the growth of demand. Growing olives is difficult. It's not easy to find good land around the world to plant olives, and that's why we haven't seen massive amount of new plantings. But what is relevant and important for us is that our company is largely independent from currency and commodity risk. So in the same way that we don't really fully capitalize on these price increases, we are really well protected from the time that the prices go down. Having said that, the current situation of shortage of oil always provides good strategic opportunities, more thinking about medium term and longer term contracts for supply.
And I'm assuming that the reusable bottle and refill pouches are more economically friendly. So have you seen more of an uptake in these products and a decrease in regular olive oil bottles, considering you said that most of your customers are, returning regular customers?
I think it's probably a little bit too early to call. The launching of the renewable pouches has been done very recently, only a few months ago. We're seeing some really nice, pleasing levels of return customers, with subscriptions ongoing. So we hope that our customers will embrace this great, convenient technology and also very environmentally friendly. But it's probably a little bit too early to fully confirm that.
And what's the share of total USA consumption of the California olive oil?
It's a very interesting one, and it's one of the reasons why we decided to go to the US. When Cobram Estate started in Australia back in the early 2000s, the Australian consumption of Australian olive oil was virtually non-existent. There was hardly any production of Australian oil back then. And the average consumption in Australia in 2000 was around 1 liter per capita. That consumption 20 years later have more than doubled, and the bulk of that growth came with domestic production, which Australia accounts now for around 45%. If we go to the US, currently in the US, the domestic production accounts for less than 5% of the total consumption. And that's why we see a massive opportunity, because the consumption in the US is just a little bit over 1 liter per capita, which is very similar to what it was in Australia 20 years ago. So the opportunities to grow a brand over there are amazing, not only because of those similarities, but also because the market in the US is around 8 to 9 times larger than the Australian market.
And do you see any potential of expansion into other international markets, potentially Europe?
We're certainly focused on Australia and California, and that's where we're focusing our resources. We do sell our product in other countries, in other continents, but the main focus in terms of our production and sales are in Australia and in the USA.
And we have someone asking, how can you keep the share price stable if weather is unpredictable and beyond one's control?
Yeah, I think probably the key there is that the way that, because of our vertical integration, we're able to manage oil supply, so variability in oil supply over 24 months, and sell that oil very consistently. We can't control the weather, but we do know that over the sort of medium term, in general terms, we'll receive a very similar yield of olive oil than what we actually expect. We do have variability year to year, but as I touched on, operationally, it's not a concern for us because of the way we can manage that oil over multiple periods.
I agree. I'll add to this that the vast majority of our shareholders have been with us for a long time, so they understand that this is more of a longer term strategic business as opposed to looking at it from a very short term perspective. In fact, we always encourage our investors and shareholders to look at our results on a 2-year rolling average as opposed to any given year, because obviously the natural variation that can happen in agriculture could be a bit misleading, usually overstating profits on an on year, understating profits in an off year, while the reality is that we sell our oil quite consistently month in, month out, and throughout the whole period.
And how do you manage olive oil supply across higher and lower cropping years?
Yeah, look, it's quite simple. We're able to store our oil. We store it in stainless steel tanks under temperature controlled, nitrogen capped, and it stores very well. But in essence, a higher cropping year, we can supply our customers for up to 16 months, and in a lower cropping year, as short as 8 months. So we manage our inventory or our oil very carefully over those periods, and what we want to make sure is that we're consistently supplying our customers with olive oil. It's not a seasonal product, so sales are very, very consistently week in, week out. So it's really the management of our oil that allows us to do this, and the fact that the majority of our oil comes from our own groves.
And is olive oil growing good for the planet?
it is actually very good, not only for us, from the health perspective, which is really well proven and known as part of a Mediterranean diet, but also it's great for the planet for a number of reasons. If we looked at our operations, as I mentioned during my presentation, olives are a net, carbon sink. So we're actually sinking more carbon than what we emit, with the production and sale of olive oil. But also, it's great from the biodiversity point of view. Being a perennial crop really encourages and hosts, a large number of insects and birds and animals and native grasses, which we encourage and help to protect and have that more stable, biodiverse environment. Very efficient user of water, very efficient user of fertilizer, and even from the waste point of view, we call it our waste zero operation, or aiming towards waste zero operation. The reality is less than 0.5% of all the outputs of all our operations actually end up in landfill. Everything else is either recycled or upcycled, as organic fertilizer, bioenergy, fuel. We produce olive leaf teas. You name it. It is a very environmentally friendly product, certainly.
And given the impact of accounting standards on your annual accounts, is operating cash flow the best way to assess your business performance?
Yeah, I think there's two ways that we'd encourage investors to think about our business, and Leandro touched on it before, but looking at our business over a 2-year rolling cycle, so it takes into account both the higher and the lower cropping years, is a key measure for us, and we'd encourage all investors to think about a business that way. And you're right, operating cash flow is a key metric for us internally, and we think it's a good measure of the health of the company. Absolutely.
Okay, well, thank you. On that, I think that's it for the questions today. Thank you so much, Leandro and Sam, for joining me. If anyone has any follow-up questions, you're welcome to email me and I can pass them on. And this recording will be posted on our YouTube. But thank you so much for joining me.
Thank you, Kate.